Dear students, welcome you to session 40, chapter Cost of Capital, Financial Management, 6th semester BCom of Mangalore University. In this session, let us determine the weighted average cost of capital. The following information has been extracted from the balance sheet of X Limited. Equity share capital 400, 12% debentures 400, 18% term loans 1200 and the total is 2000. So we have the information about the equity share capital and two types of debt. One is 12% debentures and the other one is 18% term loans. Determine the weighted average cost of capital of the company if it had been paying a dividend at a consistent rate of 20% per annum. The dividend is 20% per annum. What difference will it make if the current price of rupees 100 per share is 160? So now the current price of share is 100 and later the share price will change to 160 rupees. So we will have to calculate the weighted average capital for the present situation and also the new weighted average cost of capital when the market price changes to 160 rupees. Now the weighted average cost of capital for the present situation, that the cost of equity is equal to D by P into 100. Here we are using the dividend yield method because we do not have any information about the growth. So dividend yield method, cost of equity is equal to dividend 20 divided by the current market price 100 into 100 is equal to 20%. The cost of debt, we have information that it is 12% debentures. So we take the value as 100, the price as 100. So 12% into 100, that is 12 rupees, into 1 minus tax rate T, that is 0.40 divided by 100 into 100. Otherwise, we can directly do it as 12% into 1 minus 0.40. The cost of debt is equal to 7.2%. The next is cost of long-term loan. Again, I into 1 minus T divided by P into 100. That is 18 into 1 minus 0.40 divided by 100 into 100 is equal to 10.8%. Instead of doing it this way, we can do it as 18% into 1 minus 0.40 which is equal to 10.8%. So we have found out the cost of equity, cost of debt and cost of long-term loan. Now with this information, we can prepare the weighted average cost of capital, which is the equity share capital multiplied with the cost of equity plus debt multiplied with the cost of debt, again debt multiplied with the cost of debt, divided by total long-term funds into 100. So equity share capital is 400, 400 into 20% plus 400 into 7.2% plus 1200 into 10.8% divided by 400 plus 400 plus 1200 into 100. So it is equal to 11.92%. Now what happens is the cost of the market price changes. When the market price changes, the cost of equity will also change. So only the cost of equity changes with the change in the market price. So the cost of equity will be D divided by P into 100, which is 20 divided by 160 into 100, 12.5%. Now with this new cost of equity, we will have to calculate the new weighted average cost of capital. So weighted average cost of capital is equal to 400 into 12.5%. This we have found out now, new cost of equity, plus 400 into 7.2% and 1200 into 10.8% divided by the total long-term funds, that is 400 plus 400 plus 1200 into 100. So here the new weighted average cost of capital is equal to 10.42%. So we have calculated the weighted average cost of capital for the existing capital structure and also the new weighted average cost of capital. Students, if you have any doubts regarding any of these aspects, please do ask me. Thank you.